Well, it's a very funny thing, crypto. So I became a fan of crypto, and to me, it's an industry. I view it as an industry, and I'm president. And if we didn't have it, China would, or somebody else would, but most likely China. China would love to. And we've dominated that industry. It's a big industry, by the way. In fact, when the stock market went down recently, crypto and Bitcoin and all of that went down much less than.
Ever wonder how someone can turn influence into hundreds of millions practically overnight? What if the rules of wealth creation have changed, and billionaires aren't just born in boardrooms or tech startups, but on Twitter, blockchains, and digital marketplaces where hype moves faster than money? Meet Donald Trump, the US president who's not just staying relevant, but rewriting the playbook on how power, politics, and personal branding can translate into pure profit. In just a few short months, he reportedly added at least $620 million to his net worth, all through cryptocurrency. According to the Bloomberg Billionaires Index, digital assets are now his single most profitable investment category, outpacing even his real estate empire. But here's the real question. Is this genius, gamble, or something entirely new? From meme coins to token sales, Trump's crypto rise has sparked fascination, admiration, and no small amount of controversy. This isn't just about one man's windfall. It's about a seismic shift in how value is created, controlled, and cashed out in the digital age. So what does this mean for the future of money? For politics? And more importantly, what does it say about the system we're all living inside? Stick around, because this story goes deeper than numbers on a screen. It's about influence, innovation, and whether the next big fortune could come not from a business plan, but from a tweet. In recent years, a surprising name has surfaced in the ever-evolving world of cryptocurrency and digital assets: Donald Trump. Reports from reputable financial news outlets like Bloomberg have sparked widespread attention, suggesting that the former US president may have quietly amassed a fortune through strategic involvement in blockchain-based ventures. The initial reaction to these claims was one of shock and skepticism, with many questioning both the accuracy and feasibility of such a windfall. Yet as more details emerged, it became increasingly clear that the rise of NFTs, non-fungible tokens, meme coins, and politically themed crypto projects had created an entirely new avenue for wealth accumulation. One where timing, branding, and celebrity influence could combine to generate staggering returns. At the heart of this alleged fortune lies the explosive popularity of NFTs, particularly the Trump digital trading cards, launched in early 2023. These collectibles, released through a dedicated platform, quickly gained traction among supporters and collectors alike. The initial minting phase saw thousands of eager buyers snapping up the cards, driving significant primary sales. However, the real value surge occurred in the secondary market, where trading volumes skyrocketed and individual cards sold for tens of thousands of dollars. This phenomenon was fueled by a potent mix of scarcity, political allegiance, and the allure of owning a piece of digital memorabilia endorsed by a high-profile figure. Much like traditional collectibles, the limited supply and emotional appeal behind each card played a critical role in inflating their perceived worth. Beyond NFTs, speculation has also centered on Trump's potential ties to meme coins and politically themed cryptocurrencies. While there is no direct evidence linking him to the creation or promotion of any specific token, the broader trend of leveraging celebrity personas to drive crypto speculation cannot be ignored. Meme coins often thrive on viral energy and community-driven hype, sometimes following a classic pump and dump cycle. Yet in certain cases, these tokens evolve into legitimate grassroots movements with sustained engagement and real-world utility. Whether or not Trump was directly involved, his brand undeniably provided fertile ground for such speculation, drawing investors who hope to capitalize on the cultural momentum surrounding his public persona. Timing, too, played a crucial role in maximizing potential gains. The period during which these digital assets gained popularity coincided with a broader bull run in the crypto market, a time when investor optimism and risk appetite were at their peak. Those who entered early, whether through NFT purchases, token investments, or participation in niche communities, were able to ride the wave of rising prices and growing adoption. In the fast-moving world of cryptocurrency, being a first mover can mean the difference between modest returns and exponential growth. For someone with access to a massive, loyal following and the savvy to leverage it, the opportunities for profit were immense. Ultimately, whether the full extent of the reported fortune holds up under scrutiny, the story illustrates a broader shift in how value is created and captured in the digital economy. Traditional metrics of wealth are being redefined, and the intersection of celebrity, technology, and finance continues to open new frontiers for those willing to embrace them. At the core of any major digital fortune lies a powerful but often underestimated asset: personal brand. In today's decentralized and community-driven financial landscape, a strong public identity can function much like a currency, one that can be minted, traded, and leveraged for real economic gain. This brand as currency model has become especially potent in the world of NFTs and celebrity-backed tokens, where influence translates directly into market value. For public figures like Donald Trump, whose name alone carries immense cultural weight, this idea takes on new meaning. The launch of branded digital collectibles, or fame-backed tokens, isn't just marketing. It's a strategic financial move that turns reputation into revenue. Equally critical to these digital success stories is the power of community and hype. Social media platforms like Twitter, Telegram, and Discord have become the modern-day town squares where digital assets are discovered, debated, and demanded. A well-timed NFT drop or meme coin launch can go viral overnight, fueled by passionate followers and speculative traders eager to ride the next big trend. These communities aren't just passive audiences. They actively shape the value of the assets they support, often treating them as symbols of identity or shared belief rather than mere investments. In this environment, hype doesn't just drive prices. It becomes the foundation of a self-sustaining ecosystem where attention equals capital. Of course, even the most valuable digital assets mean little without the ability to convert them into usable wealth. Strategic timing, knowing when to enter and exit volatile markets, is crucial. Those who understand the rhythms of crypto cycles can position themselves to buy low during bear markets and sell high during bull runs, maximizing returns. However, large-scale liquidation comes with its own risks. Dumping a significant amount of a niche token or NFT collection can crash its price, wiping out value in an instant. True digital savvy, then, lies not only in building a following or launching a successful project, but also in navigating the complex mechanics of liquidity and market psychology to secure lasting financial gains. As the story of Trump's digital fortune gained traction, reactions poured in from all corners, ranging from enthusiastic support to deep skepticism. Among the most vocal proponents were advocates of blockchain technology and financial decentralization, who saw this as a natural evolution of wealth creation in the digital age. Echoing the common crypto mantra, "The future is decentralized," these supporters praise the entrepreneurial spirit behind leveraging personal brand power into new markets. To them, cryptocurrency and NFTs represent more than just speculative assets. They are symbols of financial freedom, tools for democratizing access to capital, and opportunities for innovation outside traditional banking systems. On the other side of the spectrum stood critics and skeptics, many of whom questioned the legitimacy and long-term value of such gains. Citing volatility, lack of regulation, and the potential for market manipulation, they warned against treating digital assets as anything more than high-risk gambles. Charles Dow's timeless observation that speculation is nothing more than the anticipation of the next man's folly resonated strongly among those wary of the hype-driven nature of crypto markets. Ethical concerns also emerged, particularly around the intersection of politics and profit, raising difficult questions about whether public figures should be allowed to monetize their influence so directly in an unregulated space. Political leaders and financial experts added yet another layer of nuance to the debate. Some called for stronger oversight to protect investors and maintain market integrity, while others urged caution against stifling innovation through over-regulation. Economists, meanwhile, offered mixed views on crypto's place in the broader financial landscape, acknowledging its disruptive potential while highlighting risks like volatility, security flaws, and environmental impact. Ultimately, the conversation surrounding Trump's digital windfall reflected a much larger global reckoning with the role of cryptocurrency. Is it the future of finance, or just a passing frenzy? The answer, it seems, depends on who you ask. Behind the headlines and speculation lies a trail of data that offers a clearer picture of the digital surge tied to Trump-linked assets. Chief among these is the performance of the Trump digital trading cards, which reportedly generated millions in initial sales shortly after their 2023 launch. More striking, however, was the explosion in secondary market activity, where individual cards were resold multiple times at sharply increasing prices. Industry estimates suggest that total trading volume for the collection surged into the hundreds of millions within months, with some rare editions selling for tens of thousands of dollars. This meteoric rise mirrored classic speculative patterns seen in both traditional collectibles and digital assets, where early buyers reaped outsized returns amid growing demand. To fully understand this phenomenon, it's important to consider the broader crypto market environment at the time. The period coincided with a renewed wave of retail investor enthusiasm, fueled by a bull run that saw Bitcoin and Ethereum regain significant ground following the 2022 downturn. At the same time, the NFT market experienced a resurgence, particularly in niche and celebrity-backed projects, while meme coins continued to draw attention from traders chasing quick profits. As one industry analyst noted, the period coincided with significant retail investor interest and a broader bull market in the digital collectibles space, which amplified returns for popular projects. In this climate, high-profile names like Trump's became powerful catalysts for attention and value. For those seeking deeper transparency, blockchain analytics offer an additional layer of insight. Public blockchains allow researchers to track wallet movements, transaction histories, and token distributions, providing a degree of visibility into how digital assets are acquired, held, and transferred. While definitive attribution to specific individuals remains complex due to pseudonymous addresses and intermediary wallets, trends can still be identified. For instance, spikes in transfer activity or concentrated holdings within certain wallets often correlate with reported events, offering circumstantial but compelling evidence of market behavior. In the evolving world of digital finance, data may not tell the full story, but it comes closer than most realize. The rise of blockchain technology has not only reshaped finance, but also created entirely new pathways for rapid wealth accumulation. One of the most striking examples is digital artist Beeple, whose composite artwork, Every Day's the First 5,000 Days, sold for a staggering $69 million at Christie's auction house in 2021. This landmark NFT sale stunned both the art and financial worlds, proving that digital creations, once considered intangible and easily replicable, could command value rivaling traditional masterpieces. The transaction underscored how blockchain-based authenticity and ownership could transform creative industries, while also signaling the growing appetite for digital collectibles among high-net-worth investors. Equally astonishing is the meteoric rise of meme-inspired cryptocurrencies like Dogecoin and Shiba Inu. Originally launched as jokes or parodies of Bitcoin, these tokens gained cult-like followings, largely driven by viral social media campaigns and celebrity endorsements. At its peak, Dogecoin reached a market capitalization exceeding $80 billion, while Shiba Inu followed a similar trajectory. These cases highlight the immense power of community-driven speculation in the crypto space, where narrative and hype can often outweigh fundamentals. What began as internet humor became a real-life financial phenomenon, generating overnight millionaires among early adopters and savvy traders riding the wave of retail investor enthusiasm. Meanwhile, perhaps the most well-known stories of crypto-fueled wealth belong to the early adopters of Bitcoin and Ethereum. Individuals who invested just a few $100 or $1,000 in the early days of these networks saw their holdings grow into life-changing sums as adoption expanded and prices surged. Some became accidental billionaires simply by holding onto coins they bought during Bitcoin's infancy or Ethereum's initial coin offering. These tales illustrate the extraordinary potential of investing in disruptive technologies at their inception. A dynamic that continues to inspire new generations of investors chasing the next big breakthrough in the ever-evolving digital economy. As digital assets continue to reshape how wealth is created and perceived, their growing influence on politics, regulation, and public trust raises urgent questions for the future. One of the most pressing concerns lies at the intersection of personal fortune and political power, particularly when high-profile figures appear to benefit from volatile and largely unregulated markets. The lines between campaign financing, personal income, and speculative investment are becoming increasingly blurred, challenging traditional frameworks of financial transparency. In a decentralized system where transactions can be pseudonymous and value shifts rapidly, ensuring accountability becomes both more important and more difficult. This evolving landscape has also intensified calls for clearer regulations around NFTs, meme coins, and celebrity-backed crypto ventures. While some argue that over-regulation could stifle innovation, others point to the growing risks of market manipulation, fraud, and investor misinformation. Governments and financial watchdogs are already signaling a shift towards stricter oversight, with potential legislation aimed at bringing accountability to celebrity endorsements and trading practices in digital assets. Whether these efforts will bring order without stifling creativity remains to be seen. But one thing is clear: the era of Wild West crypto is beginning to draw the attention of lawmakers worldwide. Beyond policy and compliance, the broader public perception of cryptocurrency hangs in the balance. High-profile success stories may lend legitimacy to the space, drawing in new users and institutional players. Yet they also reinforce the narrative of crypto as a speculative playground, a digital casino rather than a serious financial tool. As celebrities increasingly explore ways to monetize their influence through blockchain-based projects, the question arises: is this the future of fame-driven finance? Or are we witnessing a passing trend fueled by hype, not lasting value? The world of cryptocurrency, for all its promise and innovation, remains deeply volatile, a reality that continues to raise concerns about risk and stability. Digital assets can soar in value overnight, only to plummet just as quickly, leaving investors exposed to dramatic swings in fortune. This instability is especially troubling when tied to public figures or political entities, where the optics of sudden wealth gained through speculative markets can appear ethically murky. The core question lingers: should influence and public office serve as a platform for personal financial gain in an arena as unpredictable as crypto? And even if it's legal, does it sit comfortably with voters or the broader public who expect accountability and transparency? Beyond ethics and volatility lies the practical challenge of liquidity. How much of this digital wealth is truly realizable? A reported net worth in crypto may look impressive on paper, but converting large holdings into cash without crashing the market is often easier said than done. Add to that the difficulty of regulating decentralized global networks, and the enforcement of financial laws becomes a complex puzzle. Governments struggle to keep pace with technology that operates beyond borders, raising urgent questions about how to protect investors, prevent manipulation, and maintain trust in both financial and political systems. As crypto continues to evolve, so too must our understanding and oversight of its growing impact on power, wealth, and society at large. As the intersection of politics and cryptocurrency becomes more visible, the question is no longer if public figures will engage with digital assets, but how they'll do so in an increasingly scrutinized environment. Some politicians may see Trump's reported success as a blueprint for leveraging influence in the digital economy, embracing NFTs, tokens, or blockchain-based fundraising strategies. Others, however, may hesitate in the face of regulatory uncertainty and potential backlash over perceived profiteering from volatile markets. The path forward will likely depend on how regulators respond and whether crypto continues to gain legitimacy or faces a major market correction that cools political enthusiasm. Meanwhile, the broader adoption of digital assets by the public remains a complex equation. High-profile cases like this could either accelerate mainstream acceptance by showcasing real-world value and engagement, or they could reinforce skepticism by highlighting speculation over substance. At the same time, innovation in digital collectibles continues to evolve beyond simple profile pictures or trading cards. Developers are already exploring more utility-driven NFTs, offering access to exclusive content, real-world perks, or even fractional ownership of assets. If these trends continue, the next wave of digital ownership may not just be about status or speculation, but about redefining how we interact with value, identity, and community in the digital age.